permanently leaving Australia, the ATO can tax you before you even sell. If you think leaving Australia means your tax obligations live with you, I need you to stop right there. That is one of the most expensive assumptions I see people make. Whether you are heading back to India, relocating to Dubai, taking a job in Singapore, or returning to the UK, I have sat across from a lot of people making this exact move, and this is what catches almost all of them off guard. The day you stop being an Australian tax resident, the ATO can trigger tax consequences even if you haven't sold anything. I'm Jindal from ClearTax, and I've seen people lose tens of thousands, sometimes hundreds of thousands of dollars simply because they didn't plan before leaving Australia. You could be taxed on investments you still own. You could lose valuable capital gains tax concessions. Your rental properties can keep triggering Australian tax and rental obligations. You could lose the main residence exemptions on your family home. And if you have got a trust, company, or SMSF, that can create its own headaches too. Let's go through the biggest tax traps you need to know. Your flight date isn't your tax departure date. The first mistake people make is assuming that the day they board the plane is the day they stop being Australian tax resident. That's not always true. The ATO actually looks at the bigger picture. Why you are leaving, whether your family is moving with you, whether you are keeping your home here, whether you have set up a permanent home overseas. They also look at where your job is and how often you are planning to come back. Getting this date wrong affects almost everything. Your tax residency, your capital gains tax, your final tax return, and your ongoing tax obligations going forward. This is the foundation of all departure planning. Australian hidden departure tax. Now, this is the tax most people have never heard of. When you seize Australian tax residency, the ATO may treat certain investment as though you sold them on that day. This commonly applies to shares, ETF, and managed funds, as well as cryptocurrencies, business interest, and certain overseas investments too. However, this departure tax rule does not apply if you were a temporary resident immediately before seizing Australian tax residency. Let me give an example. Say you bought a shares for 200,000. By the time you leave Australia, they were worth 500,000. You haven't sold them and you haven't touched a cent of that money. But the ATO may treat you as if you have sold them for 500,000, creating a 300K of capital gain. That is why obtaining proper market valuation before your residency ends is extremely important. Now, there is some good news as well. You may be able to defer this tax, but remember, it is all or nothing decision. You can't defer tax on some of the assets and pay tax on others. The right choice depends on your numbers and should always be modeled before you leave. Australian property is different. Many people assume their Australian property gets hit with the same deemed sale tax. It doesn't. Leaving Australia does not trigger a deemed sale of your Australian property. However, your tax position changes significantly. Your Australian rental income will remain subject to Australian tax and reporting obligations. You may lose part of the CGT discount, and if you sell while you are a foreign resident, different tax rules apply. There is also a change coming. For CGT events from 1st of July 2027, a new indexation concession may not be available to you if you have been a foreign or temporary resident during that period. That is yet another reason to think through the timing before you leave. But the biggest trap by far is your family home. Many Australians believe the 6-year absence rule automatically protects them. Unfortunately, that's not always true. If you are a foreign resident, when you sign the sale of a contract, you generally lose the main residence exemption. That can create a massive capital gain tax bill. So before you leave, you really got 3 options. Sell before you become a foreign resident. Keep the property and accept the future tax consequences. Or hold off and return to Australian residency before you sell. And which one is right, that depends entirely on your circumstances. Selling property as foreign resident. Another surprise is foreign resident CGT withholding. If you sell Australian property, after becoming a foreign resident, the buyer may have to withhold 15% of the purchase price and send it directly to ATO. Say you sell a property for $1 million. The buyer could withhold about $150K at settlement, and now it isn't necessarily your final tax bill. You will usually claim this as your credit when you lodge your Australian tax return. But this can create a major cash flow issues if you haven't planned for it. Don't forget HECS, trust and SMSFs. Leaving Australia doesn't make your HECS or HELP debt disappear. You will still need to update your overseas details with the ATO, report your worldwide income, and make compulsory repayments once your income crosses the threshold. If you own a family trust, private company, or SMSF, things become even more complicated. Trust distributions to foreign resident can have very different tax outcomes. Division 7A loans don't disappear, and an SMSF has strict residency requirement. Simply keeping an Australian postal address does not mean your SMSF remains compliant. These structures should always be reviewed before your residency changes. So your departure checklist. Before you're leaving Australia, I recommend you work through this checklist. Confirm your Australian tax residency end date. Obtain market valuations for your investments. Model the departure tax options. Decide what you will do with your home. Understand your Australian property tax obligations. Update your HECS or HELP reporting if applicable. And review your trust, companies, and SMSFs. Completing these steps before you leave can save significant tax later. The biggest mistake isn't leaving Australia, it's leaving without a plan. I've seen people lose valuable tax concessions simply because they didn't seek advice until they have already moved overseas. If you are planning to leave Australia for good, get in touch with our team before you go. We will review your tax residency, shares and cryptocurrency, investment properties, your family home, trust companies, SMSFs, and cross-border tax implications. You will find the booking link in description. If you found this video helpful, please like, subscribe to the ClearTax YouTube channel, and send it to anyone whom you know planning to move overseas. Thanks for watching. I will see you in the next video.